Hello and welcome inside the research. I'm Pete Seyler, and today I'm joined by iCM's Chief Investment Officer, Mike Paciotti. Mike, thanks for taking us inside the research today.
Glad to do it.
So, Mike, let's get started here. And private credit has really worked its way into the headlines with some recent and notable restrictions on redemptions. Now, you talked a bit about this recently, including a section of our quarterly letter for the first quarter of this year. Do you mind elaborating on some of your concerns about the asset class and what it could really mean for markets?
Yeah, certainly. I mean, the rumblings have certainly gotten louder with private credit. So we started, as you know, we started talking about this maybe a year or a year and a half ago, and warning about some potentially ominous signs in private credit space. So the truth about private credit is we know there's some garbage there, right? There's going to be some defaults. I mean, defaults hit 9% in 2025. UBS has a worst case scenario at 15%, which actually seems quite low for a worst case. So the history with private credit is just not very long, right? So we really haven't experienced a true default cycle in the history of the asset class. So what we've seen is, because private credit is murky, right? Sketchy borrowers can borrow in private credit space in covenant light transactions. A lot of the really bad loans that would end up in public markets, low grade, high yield bonds, that stuff all went to private credit, right? So we can empirically see a noticeable credit quality improvement in public high yield bonds because of this. So to us, the relevant proxy would be lower rated high yield bonds and what that default experience has looked like historically, right? So the average default rate of lower rated high yield debt, so think C level, is about 13% per year. So that's the average. That's not the worst case, right? So if you're already at 9% and the economy's still good, it really doesn't seem like much of a stretch to get to 13. So the worst case is much worse, right? So for lower rated high yield, it hit 34% in 2009, 60% in 1990, and 31% in 2001. To us, those are kind of more reasonable barometers of, again, true worst case scenarios.
Okay, so can you talk a little bit about why it's so difficult to get a true read on this? Can you expand on that just a little bit?
Sure, yeah. Well, they're just private. They're private transactions, right? So they're not listed securities. So that's part of it. So data is very limited, and what's available is aggregate data that includes some fairly benign stuff like low loan to value loans, or some non-agency mortgage-backed stuff falls into that space. These are just truly garden variety loans with covenants and investor protections, just like public markets. By contrast, what we're starting to hear more and more about are things like payment in kind segments that can repay debt by borrowing from another source, or just kind of tacking payments onto the end of the term if you can't make it, right? So 57% of this debt in 2025 was by companies scrambling to avoid default, right? Others are risky simply because AI is disrupting the business model, right? So that's the truly kind of risky stuff that we're referring to. The question is just how much of that exists. Now, as you know, our clients are well insulated from this. Now, not only do we not own private credit, but we don't have a dedicated allocation to bank loans, or for that matter, public high yield bonds. We're even underweight investment grade corporates. So we sit way up the credit quality ladder. So for us, the primary concerns would be more market related. How much contagion spreads to adjacent assets? So we ourselves are, very, very well insulated other than the repricing of risk.
All right, so I want to, as far as your comment on contagion and infecting adjacent assets, if you don't mind, go back there for just a minute.
So now adjacent assets, floating rate debt, senior subordinated loans, bank loan funds, all of these are kind of close cousins of private credit. Same with business development companies. So there's some bodies buried there, right? So I think there's real risk. As I mentioned, quality in public high yield is actually really good. So we don't really see bad defaults being an issue there. right? It's not to say there's not going to be any defaults in the event that private credits on those markets get sold. There will be defaults, but within high yield, public high yield, that is, these are just going to be kind of a temporary repricing of risk from the contagion, spread widening, not widespread defaults.
Got it. All right. So, with some recent headlines, we've heard about funds limiting investor withdrawals, gating. Can you talk about that for a little bit?
Yeah, that's kind of the buzzword recently, gating. So I alluded to this a moment ago. Private credit underlying loans don't really trade. So the funds themselves that investors buy usually limit withdrawals to whatever is maturing or whatever coupon payments are kind of coming in during the quarter. So this whole process is what everybody's referring to as gating. So you just really can't call and ask for your money back, right? And it's kind of terrifying when you hear this. Investors panic. They try to redeem and they can't really get out. And from my perspective, right, it's actually good for the fund and good for the asset class, and really prevents those panic-driven fire sale type of drawdowns that you would normally see in an asset class when investors are all kind of heading for the exits all at once. And honestly, it's probably preventing contagion into the adjacent assets at this point.
Got it. So, Mike, if you don't mind, I want to shift gears a little bit, because we'd be remiss if we didn't address the gigantic elephant in the room, that being the ongoing conflict in Iran. Can you talk a little bit about the initial market impacts of this conflict as it relates to stocks, bonds, real assets, and then closed-end funds?
Yeah, if you look at conflicts over time, markets typically react really poorly at the onset of fighting. They did this time too, and then actually they do reasonably well over the next 6 months. So when you think about it, conflict does have an economic impact by increasing government spending, right? Unless there are spillover effects onto the consumer and the business investment segments of the economy, all of that just kind of typically continues, right? So in this case, the wild card is oil, right? So that has potential to restoke inflation, right? If you do the math by applying the weight in the various inflation baskets times the increase in the cost of oil, it could be nearly a 3% increase to inflation. Now, caveat, other things would cool along the way. So the math isn't as linear as I presented it, but there's risk there. There's risk for inflation reemerging. Now, a few things that I think are worth clarifying. This is a global problem, despite what you might hear, right? So just because the U.S. is quote unquote energy independent doesn't mean that we're not impacted, right? Oil companies are private businesses that sell onto an open global market at the then current market price. We are impacted directly and indirectly as other goods increase in price. Asia has a slightly bigger problem in that 80 to 90% of the oil flowing through the Strait goes to Asia. So now the reports have been a bit sensationalized with, with some some saying that Asian economies would grind to a halt in 1 month's time. So Japan has roughly 250 days supply of oil, South Korea 200, China 100 days, which China has reportedly been receiving oil from Iran since March 1st, right? The reports are 11, 12 million barrels coming to China from Iran, which they could be either using themselves or selling it in the market, right? So that's all happened since the Straits closure. India kind of appears to be the most vulnerable at 50 to 60 days supply. I think this is going to get solved, mainly because it needs to, and every nation really has an interest in it being solved.
All right. So can you talk a little bit about the initial market impacts of this conflict as it relates to stocks, bonds, real assets, closed-end funds?
Sure. Well, there's two primary impacts, right? So does it impact anything in the near term, say 1 to 3 years for real earnings, right? So the answer is certainly it could, especially if the inflationary impact is long lasted. And then the second impact is it impacts the discount rate, right? As risk-free rates rise, the fair value of long-term assets, stocks, bonds, that all declines. So the fact that The markets have only declined modestly, tells us that collectively investors really believe that this is it's going to be brief. So for us, really the losses have been in risk assets have largely been offset by massive gains in commodities, right? With our equity portfolio still up 4 to 5% year to date as of the last week of March, and the S&P is down 3 to 4% over that time period. So we've actually held up quite well.
Great. So now, how about closed-end funds?
So yeah, the discounts have come out a bit. As you know, we're pretty defensively positioned there. So for us, the impact's been marginal, and I think this is really going to be, a good opportunity for us to use some dry powder and scoop up some bargains if there is some carnage.
Great, Mike. So as we bring this to a close, the last question, in your experience over the last 25 years of managing portfolios, do you have any advice on how investors really should react to a geopolitical event that creates volatility or uncertainty?
Yeah, I think investors have gotten better. At least it seems like we have, right? So investing has become far more mainstream now since my career began, right? In the mid 1990s, no one had really experienced the true bear market since the 1970s. So when the internet bubble burst, that was bad, mainly because of how long it lasted. But a lot of investors got lured into these internet names, and the NASDAQ declined by 70-ish% from peak to trough. So there's quite a bit of panic there. And I feel like we've all kind of been there, done that at this point. Most of us have had the internet bubble or the financial crisis, or at least COVID, right? The stock and bond meltdown in 2022. So there's been a couple at this point, right? And the best advice I could kind of give investors while markets are still near their peaks is to kind of go back and look at some of their best years. And instead of thinking about them as the best years, put a minus sign in front of them, right? And if you don't like what you see, you're taking too much risk in your portfolio. So, as you know, for us, we generally stay out of the really speculative, frothy stuff. So we're pretty boring. When markets are racing up, we might lag a little, but our view is it's not how much you make, it's how much you keep. So we've been generally pretty good at that part, right? With 2022 and really this most recent experience as evidence of that statement.
Well, Mike, thanks for taking us inside the research today. And for our viewers, thanks for taking the time to watch this video. If you've enjoyed it, please like it, share it with your colleagues, and don't forget to subscribe to our YouTube channel to receive notifications of new content when it hits the channel. Thanks for watching.